What if you invest $100,000 in the best 3 dividend stocks? You might have carefully planned your retirement and ensured a stable foundation for the future with the help of ETFs. But what if we told you that you could supercharge your portfolio with the right dividend stocks? Stocks that not only provide steady income, but also offer long-term growth potential. Finding the best options can feel overwhelming, but don't worry, we've done the work for you. Today we're diving into 3 incredible dividend stocks that could transform your financial future. We'll break down their business models, highlight the risks you need to know, and rank them from great to game-changing. Stick around until the end, and we will reveal the top dividend stock that has the potential to turn a $100,000 investment into a jaw-dropping portfolio worth over $2 million in 30 years. Ready to uncover the secrets of long-term wealth? Let's get started. KMB. Let's begin with Kimberly-Clark Corporation, or KMB for short. This company has been a cornerstone in the consumer staples sector since its founding in 1910. With a market capitalization of approximately $43.27 billion, KMB is a significant player in the industry. You might be more familiar with their popular brands like Huggies, Kleenex, and Scott. Of course you are. These are household names across the globe. They do have some challenges though. For one, KMB depends a lot on raw materials, and fluctuations in those costs could eat into profits. Competition against other industry heavyweights like Procter & Gamble can also have an impact on its growth. But as you know, we would not recommend it if it was all bad news. The good news is, just like any other businesses that operate in the consumer staples sector, they don't rely on crazy growth to do well. Instead, the company focuses on providing everyday products that people always need. Think tissues, diapers, and paper towels. KMB's solid brand loyalty and strong supply chain around the world have proven its ground over decades with growing market shares. In the end, while no investment is entirely risk-free, KMB offers a pretty solid balance of reliability, growth potential, and defensive strength. If you're looking for an investment that can ride out the storm while still offering consistent returns, KMB could be worth considering. In 2024, KMB's share price was pulled back by 15%. Despite the global economic slowdown, KMB was doing alright with modest increase in revenue. However, their earnings decreased by about 8.8%, owing to higher costs for raw materials, shipping, and energy. But that is all it was, a slowed down momentum. As their business focuses on consumer staple, it is a good fortress against the economic slowdown and uncertainties. Despite the slight decline, the company maintains a healthy dividend yield of 3.74%, offering $4.88 per share, which is appealing to income-focused investors. Analysts have given KMB a buy rating, with a dividend growth of 3.39% per year and an annual return on share price of 2.05%. This indicates confidence in the company's stability and future prospects. If you invest $100,000 in Kimberly-Clark, KMB, here's how your portfolio could grow over time. After 5 years, your investment would be worth approximately $133,000. If you stick with it for 20 years, your investment could reach an impressive $343,000. Finally, over 30 years, the compounding effect could turn your $100,000 into an extraordinary $693,000. Your dividend income is great, at approximately $3,000 a month. This highlights the incredible potential of reinvesting dividends and letting time work its magic on your investment. This is good, but you know it could always be better. Let's move on to MRK. Merck & Company Incorporated is commonly known by its stock ticker MRK. Founded in 1891, Merck has established itself as a global leader in the healthcare sector, focusing on innovative medicines, vaccines, and animal health products. Merck is a giant in the healthcare industry, known for blockbuster products like Keytruda, a leading cancer therapy, and Gardasil, a vaccine that protects against HPV, a virus linked to several types of cancer. By tackling some of the deadliest diseases, Merck is clearly on a mission to make a big impact. But even giants face challenges. Keytruda is a massive moneymaker, but its patent expiration is on the horizon, which raises questions about future revenue. Plus, if Merck's pipeline of new drugs doesn't perform as hoped, it could face pressure in an industry crowded with big players like Pfizer and Bristol Myers Squibb. The good news? Merck sees those challenges coming. The company is doubling down on research and development and expanding its portfolio of innovative treatments to solidify its position in the healthcare market. Despite reporting an impressive $63.17 billion in revenue over the past year, Merck's stock dropped 24% in 2024 after it cut its earnings forecast. Slower than expected sales of Keytruda, coupled with fierce competition, played a big role in the decline. That said, Merck has a strong track record of developing groundbreaking drugs year after year. While short-term concerns might spook investors, Merck's long-term commitment to innovation could help it navigate these challenges and come out even stronger. Not convinced yet? Now let's look at the performance metrics. First up is the dividend yield, which is currently sitting solid at 3.29%, with annual growing rate at 5.41% per year. So not only are you getting a consistent payout, but those payouts are increasing over time. For share price growth, it has a solid rate of 6.79% annually. This is where you see the real potential for capital appreciation. Combine that with the growing dividend, and you've got a powerful mix of income and growth working for you. If you invest $100,000 in Merck, the growth potential is remarkable. After just 5 years, your investment could grow to around $162,000. Stick with it for 10 years, and your portfolio could expand significantly to $262,000. Over 20 years, the compounding effect really takes hold, with your investment potentially reaching $688,000. And if you stay invested for 30 years, your portfolio could grow to an extraordinary $1.8 million. This showcases the incredible power of combining dividend growth, share price appreciation, and a long-term mindset. Notice the similarities in dividend incomes? Over the first 5 years, the dividend income generated by MRK is roughly on par with KMB, thanks to their comparable dividend yields of 3.29% and 3.74% respectively. However, the story changes dramatically over the long term, with MRK's higher annual return on share price of 6.79% versus KMB's 2.05%, and a faster dividend growth rate of 5.41% versus KMB's 3.39%. It carves out a significant edge for itself. These factors lead to much larger portfolio values and dividend income as time progresses. Now, for the big gun, let's take a look at PEP. PepsiCo Incorporated, PEP, is a company that has been a household name for decades. Chances are you had your soda phase, and if you didn't, you still could not possibly have avoided PepsiCo. From Pepsi and Mountain Dew to Lay's, Gatorade, Tropicana, and Quaker Oats, Pepsi must have been a huge part of your life. PepsiCo is a powerhouse with a strong portfolio of brands and impressive financial stability. But no investment is without risks. Things like rising commodity prices, currency fluctuations, and shifting consumer trends can impact the bottom line, so it's smart to keep an eye on these factors. Even though PepsiCo saw steady revenue growth in 2023 and 2024, its stock took a hit during that time. Why? Rising costs, like pricier ingredients and higher shipping expenses, put pressure on profits. Sales were solid, but those increased expenses made investors nervous, which led to the stock's dip. That said, PepsiCo's diverse product lineup and global presence make it well-positioned to handle challenges and stay strong for the long haul. It's a classic case of short-term bumps versus long-term potential. PepsiCo stands out for its commitment to rewarding shareholders with a dividend yield of 3.57% and an impressive annual growth rate of 7.79%. PepsiCo consistently delivers steady income. Add that to an annual share price growth of 5.64%, and you're looking at a solid balance of income and capital appreciation. It's a win-win for investors seeking both stability and long-term growth. Now let's see how your $100,000 could grow if you put it in a PEP. Based on the above metrics, in just 5 years, you could see your investment grow to around $157,000. 10 years down the line, and you'd be looking at approximately $250,000. How exciting is that? And it gets better. After 20 years, your investment could potentially balloon to around $679,000. And in 30 years, you'd be looking at a hefty sum of over $2 million. Now that's some serious growth. Isn't it fascinating to see how the power of compounding can work in your favor over time? When you look at the projections for both Merck and PepsiCo, you'll notice that the portfolio values in the first 20 years are somewhat similar. Both companies provide stable growth thanks to their solid business models and consistent returns. However, the key difference starts to emerge after 20 years. Pep's higher dividend growth rate at 7.79% per year, compared to MRK's 5.41% per year, starts to really pay off as time goes on. With Pep's dividends growing faster, the income you receive from those dividends begins to compound more quickly, leading to higher reinvestment and a much larger portfolio value in the long term. That's it, the best dividend stocks to invest right now. Whether you're drawn to Kimberly-Clark's stability, Merck's potential for steady growth, or PepsiCo's powerful dividend reinvestment through higher growth, all three offer unique opportunities for long-term investors. If you're looking for solid, dependable investments to supercharge your wealth over time, these stocks are worth considering. Don't wait. Start investing in KMB, MRK, and PEP today and watch your portfolio grow for years to come. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already. And hit the notification bell so you don't miss out on future tips.